And now we move on to a very important aspect, friends. I am delighted to announce a very brief yet very significant sub-event of today's proceedings, and for which a few of us have been waiting with bated breath. FEDAI has been at the forefront in increasing knowledge and foreign exchange of bank officials. The flagship one-week FEDAI workshop and FEDAI books have helped thousands of bank officers in their career progression over the years. Hence, it was quite natural that when the Reserve Bank of India started capacity building mission in the banking industry in 2016, the responsibility to groom professionals in the field of foreign exchange was to be shouldered by this great institution of ours. The syllabus of IIBF's certificate course on foreign exchange operations is based on FEDAI books, and which are of course updated with contemporary changes from time to time. Every year, we also award employees of authorized dealer banks who score high grades in the certificate course exams. Please join your hands and raise a toast in appreciation of the top scorers for the FY 2021. And the top scorers are, in this order, Kakkar's image, please. So that is Mr. Rakesh Kakkar. Congratulations, Rakesh, on being one of the top scorers. We have one more top scorer, and that is Mr. Muhammad Arif, Indian Bank. Congratulations to Mr. Arif as well. And the third top scorer that we have is, and I'm very proud to state that it's a lady, it's Miss Rolini Chakraborty from State Bank of India. Congratulations, Miss Rolini. And hearty congratulations to each one of you. May you do exceedingly well in your lives and careers. Your certificates will be dispatched shortly by FEDAI. Congrats once again. Dear attendees, I hope you are enjoying every bit of the proceedings today. I'm equally happy presenting each sub-event to you as we move along. Moving forward, I'm extremely pleased to announce a 1-hour power panel discussion on use cases and future potential of CBDCs. Technically speaking, we'll have about 45 to 50 minutes of discussion and about 10 to 15 minutes of Q&A, time permitting. Firstly, a few words about why such a topic was curated for today. Today, forced by COVID-19, the world trade is getting digitized at a highly accelerated and frenetic pace. Payments and settlements are happening online in a virtual environment. Given the recent headlines around cryptocurrencies, many central banks around the world have warmed up to the idea of issuing their own digital currencies, or which are popularly known as central bank digital currencies, or CBDCs. In 2021, the Bank for International Settlements, BIS, a global organization for central banks, published findings from a 2020 survey that showed that 86% of central banks are engaging in research and projects relating to CBDC, and up to 80% in 2019. According to the survey, increasing work is also being done on retail CBDC relative to wholesale CBDC, with central banks choosing either to work on both wholesale and retail, or focusing instead on retail alone. So therefore, to deliberate on this important topic, we have amidst us some very senior regulators, bankers, and industry professionals as part of this elite panel today. Please permit me to introduce each distinguished panelist to you, ladies and gentlemen, even as they take a virtual stage. The first one, and I warmly welcome Mr. Wee Ki To, Advisor BIS, Singapore. Mr. Ki joined the BIS Innovation Hub in May 2021 to lead Project Dunbar with a vision of enabling interoperable CBDCs and connected multi-Cbtc platforms. And prior to joining the Innovation Hub on secondment from the Monetary Authority of Singapore, MAS, V was the specialist leader for distributed ledger technology and led Project UBIN, a collaborative industry project exploring the use of blockchain and DLT for clearing and settlement of payments and securities. The second guest on board today is Mr. Naveen Malela, Global Head of Onyx, Jpmorgan, Singapore. Welcome, Mr. Naveen Malela. Based in Singapore, Naveen currently leads point systems globally for Onyx, Jpmorgan. And as part of the role, Naveen is responsible for launching a new product line for wholesale payments based on digital currencies, extending his work on JPM Coin, for which he was the chief designer and the product head. Prior to that, Naveen was leading the digital function for wholesale payments in Asia Pacific, where apart from digital currencies, he was actively involved in designing and launching the first of its kind data visualization platform for wholesale payments. Gentleman who's now going to join us with this elite panel is Mr. Keith D'Souza. Welcome, Mr. D'Souza, Executive Director and Team Head, Funding and Liquidity at DBS Bank, Singapore. Keith looks after funding and liquidity for the bank, including the institutional bank, consumer banks, and treasury and markets. The desk is also responsible for managing the short-term wholesale funding programs, including US commercial papers and the Euro commercial papers. Last but not the least, we have a representative from our regulator, and I warmly welcome Mr. Anuj Ranjan, General Manager and Head Fintech Division at Reserve Bank of India. Welcome, Mr. Ranjan. Mr. Ranjan has close to 22 years of experience across various central banking functions like currency management, and has been actively involved in policy domain related to banking and non-banking regulations. He currently heads the Fintech division, wherein initiatives like a regulatory sandbox, setting up a Reserve Bank Innovation Hub, operationalization of CBDCs, etc. are being undertaken. Mr. Ranjan holds a master's degree in science. Having done the honors of introducing that, I've been very brief. I did not want to take too much time. I would rather give more time to the panelists. So I therefore request Mr. Naveen Malela to take over from here and initiate this panel discussion. Thank you very much, gentlemen.
Thank you, sir, for the very warm introduction. First and foremost, good afternoon, everyone. And on behalf of my fellow panelists, I'd like to express a round of thanks to the organizers for getting us together. So what we'll attempt to do in the next 45 minutes or so is do the rounds among the panelists and address the various aspects of CBDCs and the use cases around it. There is an app for questions, so please do send in your questions throughout the panel discussion, and we will attempt to weave that into the conversation, else we can take it up towards the end. So to kick proceedings, maybe I'll start off with Anuj. So Anuj, if I could pose the question to you, given the recent announcements from RBI on CBDCs, what do you see as the use cases, given you're leading some of the work in this particular space? India arguably has some of the most modern payment infrastructure which is out there. So what else is the gap that CBDCs can fill? So Anuj, if I could request you to kick off proceedings with that question.
Yeah, it seems there is some camera. Just I'll switch to.
Sure.
Yeah. Good afternoon, and thank you very much to Mr. Sinha and his team and the organizers for inviting me to be part of this panel. And thanks to Mr. Devi Shankar and Naveen for raising this very pertinent question. This is as our Deputy Governor said, this is a very important and this is a hot topic which is going on. And as you have put it, this law. So I hope my camera is, I'm visible?
It's working, Anuj. Please continue.
Thank you. So, see, when we have said that we are exploring the launch of, there are certain aspects which we are examining. As we have said, it is going to be a phased implementation. So, the first foremost consideration which is there in our mind is that we are looking at least disruption, or to the extent even no disruption. That would be the kind of the driving force, because we don't want things to get disrupted in any which way. Then we are also looking at whether the scope, we have to look for retail or the wholesale or both, as Mr. Dev was indicating that different countries are experimenting on either or both. Then the underlying technology, whether it has to be a centralized one or a decentralized ledger, the validation mechanism, whether we need to issue tokens or it will be account-based, and then distribution architecture, whether central bank will directly issue or it has to be done through intermediary, or it has to be used as a hybrid model or indirect model, as we say. And above all, the degree of anonymity, because as we have always said, it has to kind of replicating cash in digital form. So if there is a certain anonymity associated with cash, we need to see that the acceptance is there, and therefore what kind of anonymity, degree of anonymity, what reasonableness is required, that is being examined. And so these are the issues which we are examining and exploring, and maybe within a few months from now on, maybe we'll start a pilot, and the POC is being worked out. On retail, there are several use cases. In fact, it is limitless, as we all know. But what we can examine is like a programmable CBDC, where maybe a direct benefit transfer can be achieved, where we know where this money is going and it is going for the right uses. Similarly, we can also think of cross-border remittances where it can be used, because this is one area where India is having a lot of inbound remittances. So how do we use CBDC in this segment and ensure that cost and the convenience to consumers are ensured? We can think of in retail, consumer to consumer, whether I can transfer money from my wallet to another friend's wallet or a peer's wallet, whether it can be used for payment for services, products, or for business to business, whether corporate account can be transferred. Another very important from Indian perspective could be whether we can use CBDC for MSME lending purposes. This, as more and more MSMEs use this, it will be much easier for us to find out, understand the borrower's risk profile. Sometimes when we need to push stimulus into the sector, this could be done very fast. And the traceability helps MSMEs also prove their credit worthiness. So it's a lot of use cases in retail. And since this is a FEDAI annual day function, wholesale is going to be, because we are talking about Forex. And therefore, in wholesale, there are specific purposes, CBDCs, also like between two banks or financial institutions, or between central bank and financial institution or a bank. So wholesale CBDCs, the limit is access is limited to a very select group of users, where that is not the case in retail, because it is more widely, you can be used without any restraint. So in wholesale, I would say the settlement risk, which almost could be nil or almost negligible, has significant potential benefits of using this in whole segment, whether it is in domestic use cases or also in cross-border context. In domestic uses, I must say the government bond market presents a very useful setup for CBDC uses. The funding leg of interbank settlement in GSEC market can easily be settled through CBDCs. So this will have a real-time T+0 kind of settlement and allow central banks to have more real-time view who is holding in the market, participants who are holding the bonds. So domestic, a lot of use cases can be experimented and thought of. In cross-border, the opportunities are there, but then there are contagion risks associated with that. So the benefits, I would say, is that opening hours, it eliminates any mismatch of operating hours. Then the calculation rates and the fees, these are all available easily, and the compliance cost therefore reduces, and which ultimately leads to a reduction in the transaction cost. It can alleviate a lot of risk. The counterparty risk, as CBDC can represent a claim on the central bank, and therefore the safest settlement asset available, it could be one of those. So it will kind of replace the features of cryptocurrencies and therefore replace the public appetite for real-time cross-border transfers. But there are concerns. The opportunities comes, then there are challenges, and it could undermine the financial stability. There could be a sudden outflow, capital outflows, which will destabilize the financial stability. So these are all options. These are being kind of weighed, and positives are being looked into, and therefore this will go on a pilot and try to understand what best can be put when we move on to a live environment. So that is kind of, I'll sum up on retail and wholesale. Naveen, thank you.
Thanks, Anuj. Actually, that was a very comprehensive coverage of everything which is out there. Design considerations you touched upon, account-based, token-based, centralized ledgers, decentralized, validator nodes, who validates. I mean, that's very comprehensive. A question does come to mind. A few months back, we were presenting to Jamie Dimon about some of the work that we were doing on digital currencies. And we were talking about this aspect of inclusion, financial inclusion, especially retail CBDCs. And his question was, like, take India, for example. How has India been able to do financial inclusion in such a massive manner without CBDCs? And when I hear you speak about the use cases, then, it's not just about financial inclusion. Though people just talk about financial inclusion as the key use case for retail CBDCs, it is not just about that. It is about direct benefit transfers. It is about peer-to-peer. It's about programmability. You covered a number of things, Anuj. So that was very helpful. You did touch upon minimizing disruption. The jury is out there in terms of whether central banks with CBDCs will start getting closer to credit creation. Will they start displacing commercial bank money and commercial bank deposits? What's your thought process? Even though you answered it to a certain extent by saying no disruption, would that be a guiding principle for RBI's pilot? Or would it be a more nuanced view that there could potentially be flight from commercial bank deposits, in which case the concerns from commercial banks are, would it not raise the wholesale funding costs if basically there is displacement of deposits? So any perspectives, Anuj, that you can share on that?
Yeah, that's a very valid question and concern. And as I said, and you also mentioned that it has to be non-disruptive. So the question that comes to the mind, that what happens to the banks, what happens to the financial institutions in between. And as I covered in the first part, that the idea is that we replicate cash in digital form, as we say it. So we would like to follow the same kind of process so that the banking sector disintermediation doesn't happen. And for that, see, the disintermediation happens only when there is a interest-bearing CBDC, so that it becomes lucrative to the people and they will hold CBDC, and there is a flight of deposits from the banks. But as again, at the cost of repetition, I would say that we are looking at just having a digital form of the physical currency. So the question of banks losing the deposits, to that extent, if it is an interest bearing, will not arise. However, I must add here, and I must hasten to add, that CBDC being seen as a central bank liability, and it is kind of an aspiration for people that, okay, I was holding a physical currency till now I have a digital currency, which is a central bank digital currency. That aspirations will kind of lead to people holding CBDCs in their wallets or accounts, as the case may be, as a token or an account. So to that extent, there could be some deposits moving out, or people keeping more deposit, because there is a, as I said, that it is a central bank money. But we can address that aspect also, that maybe we can put a cap on the per capita holding of CBDC, so that the economy benefits from the attributes, the technological attributes, or the technical attributes of the CBDC, while it also ensures that there is no behavioral change in the financial saving in the economy. So again, it's as I said, the entire world is grappling with all these issues, but so far as flight of deposits, I don't think in the long run, behavioral changes do take some time to happen. But in the short run, or even in medium term, we find that by having certain kind of design features on the CBDCs, there is no disintermediation going to happen. Now, another part I would just like to add, since it is in digital form, if there is a run on the bank, there is a possibility that people will withdraw the CBDC immediately because they don't want the money to go waste or gets into all kinds of legal issues. So, but we are looking at the positive side of this, that because it is very easily available, there could be a comfort to the people that, okay, this is a central bank digital currency I am holding, and so let it be lying in a wallet, because ultimately I'll get, because it is backed by the central bank of the country, and central bank will survive till we all survive. So that kind of comfort comes into the system. We can, in many jurisdictions, the credible deposit insurance will also dissuade people from having these runs on the bank, and therefore this could be one option. Then, as I said, we can have design features to ensure that, that there is no impact on the credit creation, and the commercial bank deposits continue to be as safe as. Only thing is, people get the benefit of using digital mode and build up on the current, as you said, innovative and modern infrastructure of payment systems in the country. So it's more of complementing cash and complementing the physical infrastructure, the infrastructure which is available in payment systems. So that is how I would put it.
Very, very, very clear, Anuj. And I think you've touched upon all of those angles where, you know, you view it as cash-like, non-interest bearing caps, holding caps. And this is where programmability comes into being, right? The fact that you could program into the money itself in terms of how much could be held in a wallet. You know, things like that give you a lot more choice in terms of how you implement that. And as you've touched upon during bank runs, for example, holding a central bank liability means that people generally feel safer about it. Technically, central bank, the credit risk associated with central bank should be close to zero, if not zero. So very comprehensive coverage, Anuj. So I would probably then maybe shift, and I'll come back, to round up the discussion. But turning over to Vicky, Anuj has given a wide range of use cases for CBDCs, both retail and wholesale. As part of Bank of International Settlements, BIS, you've been leading Project Dunbar. You've been working with 4 central banks, MAS, Reserve Bank of Malaysia, South Africa Reserve Bank of Australia. What do you see as the emerging themes from a use case standpoint for CBDCs? And do you sort of concur with what how Anuj and how RBI is seeing the use cases play out?
Yeah, thanks, Naveen. So I think a lot of what we are seeing is very aligned to what Mr. Anuj mentioned in his response earlier. So for me, I'll just focus on the wholesale transactions perspective, as that has been the main thrust of our work on Project Dunbar, as well as the other CBDC projects like Project Ubin that I'm more familiar with. So I see that the primary use case is really in cross-border payments. If you look at most developed economies today, domestic payments are very efficient. Transactions are settled instantly, costs are also very low. But contrast that with cross-border payments, transactions could still take days to complete and costs are significantly higher. So the big question really is, why is that so? So when we look at domestic payment infrastructure today, they are very well developed. You have central clearing and settlements. Everyone is directly connected with each other through a national payments infrastructure. So, but if you look at cross-border payments today, there's no real concept of international settlements platform today. Settlements takes place within the books of correspondent banks, and a single cross-border transaction often have to go through multiple hops, across different correspondent banks. So what we are seeing is that if we allow for CBDCs, it actually enables transactions to take place directly between the parties, the transacting parties, and this would actually reduce the need for intermediaries and make cross-border payments cheaper and faster. So to me, I think that is the primary and the strongest use case for CBDCs is really in cross-border payments. Now, the other perspective is really from the perspective of FX, which I think is what many of us over here are very interested in. So if you think about it, all of these financial institutions, they have the ability to hold and transact with different CBDCs in different currencies directly. They would also need and have the ability to easily exchange CBDCs with each other. So the next step, of course, is really to see how foreign exchange transactions can be done seamlessly and safely, safety being a primary concern over here. So we are able to look at building payment versus payment or PVP functionalities to eliminate counterparties risk. So for example, how do we enable PVP transactions between all of these different CBDCs? And once we have the ability to do this using smart contracts to enable this coordination that is done automatically by smart contracts, you can actually enable PVP very easily, efficiently, and at very low marginal cost. So there is no need to rely on certain intermediaries or trusted intermediaries to coordinate this exchange of CBDCs. You can actually do it using smart contracts. The smart contracts are trusted and they don't incur a significant cost. The other, those are, I guess, more of the immediate use case that we are looking at. And another big futuristic use case is really in terms of programmable money. So like what Mr. Anuj mentioned earlier in his response as well. So what if we actually have the ability to program money and make money smart? What can we do if money is smart and we can build rules into it? So on the operational perspective, we can build many of the current operational requirements and rules into this smart contracts itself. So from an operational perspective, that would save manual processing time and cost. But that's really just from a very basic level of it. What if we, on the next level is, what if we actually enable conditional payments, or payments that happen only after certain criteria or conditions have been met? So imagine how helpful it would be for trade transactions, for example, money being released automatically when goods are delivered. Or it could even be integrated with IoT, Internet of Things devices. So for example, you have some trade transaction, trade meaning physical trade, and you are saying that, okay, these goods are very sensitive, temperature needs to be highly controlled. So you could actually have IoT devices that monitor the temperatures, and if you know there's too much temperature fluctuation, funds are automatically withheld even when goods have been delivered. So you can start looking at codifying all of these different conditions into the payments itself. And that's really the big opportunities over here once we are able to make money smart, make money programmable. So I think this is really a really fascinating field, you know, this whole idea about digital currencies, because there are just so much opportunities that are made possible once we have smart digital money, especially once we start looking at how these different use cases intersect and how we actually can enable interconnectivity and interoperability to support all of these different use cases.
Thanks, Vicky. You touched upon a few key points over there. First and foremost is cross-border payments. Like today, you know, given the fact that domestic payment infrastructure, there is no interoperability, invariably correspondent banking and commercial banks come into being in terms of cross-border payments. You know, selfishly from a key standpoint and our standpoint, it's a major source of revenue for us. You know, but it looks like it's only banks who love correspondent banking, nobody else does. And with CBDCs, you have the opportunity not to go through correspondent banking or commercial bank. You could directly settle in central bank money, central bank to central bank. But it does raise the question of, you know, and probably that's a separate question, but, you know, cross-border payments disproportionately are settled on commercial bank money. Commercial bank money in terms of M1 money supply outnumbers M0 by 10 to 1. So if you have to do wholesale migration from commercial bank money to central bank money, you know, what does it mean to money supply, right? I mean, I think a whole host of topics, but you touched upon the fact that the technology allows you to do settlement without commercial banks, purely on central banks. That's one. You added to what Anuj was saying in terms of programmability, conditional triggers, the ability to program payments at the back of events. So that was the second one. Third thing, FX payment versus payment, which should be of immense interest to this audience, the ability to take out settlement risk. And we will touch upon that topic a little bit more. I do have a question come up from Kashinath Katakton. Thanks a lot, sir, for sending out this question. For the rest of you, please do send out questions. Kashinath talks about, his question is around interoperability. When you talk about CBDCs across different countries, you know, how do you address interoperability and seamless connectivity? And Vicky, I know that that is a topic which is very close to BIS. You published 3 different models. There seems to be an emerging pattern out here in terms of corridor networks. So Vicky, the floor is yours. I know that you're the absolute expert on this topic, so I'll turn it over to you.
Yeah, thanks, Naveen. So this is really a topic of immense interest to us. So, you know, when we talk about CBDC interoperability, there is actually a very good paper published by my colleagues from the Bank for International Settlements in March earlier this year. It's titled Multi-Cbtc Arrangements and the Future of Cross-Border Payments. So a very fascinating paper. So, you know, if you guys have the chance, do take a look. So the paper discussed 3 conceptual approach to cross-border CBDCs. Now, the first is really an arrangement based on compatible CBDC systems. So they are not looking at direct linkages, and they are not looking at direct linkages between systems, and it behaves very much like payment systems today. So I probably wouldn't be going too much into that. From an innovation perspective, our interest is really in Model 2 and Model 3, where we look at new models of enabling cross-border transactions that could really make cross-border payments much cheaper and faster. So Model 2 looks at interlinked CBDC systems, meaning that there are different CBDC systems existing as individual domestic CBDC systems that could be linked up, so connected to enable cross-border payments. Model 3 looks at a single multi-CBDC system, meaning a single system, a single common platform for multiple central banks to issue their respective CBDCs. So some people tend to refer to this as the corridor network. I tend to refrain from using the term corridor, and it gives the sense of connecting 2 parties. But what we are looking at over here is really about connecting multiple different parties in a scalable way. So I'll just explain a bit more about the 2 models. So Model 2 of linking up CBDC system is something that central banks have been exploring even before it was actually so well described in this BIS paper. So some examples include the Jasper Uvin project in 2019. So many central banks have been doing domestic CBDC projects And cross-border CBDC is really a natural next step for central banks. So usually what they do is they start by establishing bilateral linkages because those are the easiest to establish. The problem though with such bilateral linkages is that scalability is not great because the linkages scale exponentially. So to link up 10 systems, you need about 50 connections. That sounds quite reasonable. 50 systems need over 1,000 connections. That starts to go into this difficult to achieve range. And 100 systems need about 5,000 connections. That is really very difficult to accomplish, not just from a technical perspective, but from a business perspective as well. So even when we were doing Project Ubin back in a couple of years ago, it was already recognized that more effective models of linking up platforms need to be explored. So this is why there is currently a lot of interest in Model 3. Model 3, which is what we are currently looking at as part of Project Damba. This is a set of work by the BIS Innovation Hub with the central banks of Australia, Singapore, Malaysia, and South Africa. What we are looking at is really a single platform for multiple CBDCs. So imagine you have one single platform where all transactions can take place directly on. So multiple central banks issue their CBDCs on this platform itself. So once you do that, you have the different currencies circulating on the platform. Now, if you are a participant on this platform itself, you have the ability to transact directly with each other in all of the different currencies. So in such a model, cross-border payments can be made to be as efficient as a domestic transfer because everything takes place on a single platform. There's no need for intermediaries, which means less fees and less processing time. So in an ideal world, this would be the most efficient model. We have already seen it in a domestic context, a single shared platform for a single platform for all the commercial banks is usually the most effective and efficient model for doing transactions. But to do this on an international level, there is a very big elephant in the room. How do you get central banks to share such an infrastructure? How do you get central banks to record their liabilities in a platform that is not solely within their control? Because ultimately, this is a shared platform. So we think that technology can lower the barriers and put in place sufficient controls such that central banks feel comfortable sharing a platform with others. But then again, even with this lowered barriers, there's still a question. Can all central banks in the world agree to such a sharing arrangement? I think that would be ideal, but actually really too idealistic and naive to think so. But can we lower the barriers enough for trusted regional partners? I think potentially we could. So if you look at countries like South Africa and the region, they actually already have a regional RTGS, which is proof that regional partnership, regional transactions is viable. So I think that is something that we probably will see in the midterm, regional central banks coming together to build shared settlement platforms on a regional level. So this is really Model 3, but on a regional level. And of course, the next question is how these regional platforms could be linked up for settlement on an international level. Now, if you are down to 5 to 10 regional platforms, for example, then the scalability concern with Model 2 is actually much lower impact. And then we could also look at whether there are more efficient means of linking up of these different regional platforms. So I hope that gives a bit of an overview and explanation of the different models of cross-border CBDCs that we are looking at, and you know how we could actually look at linking up these different platforms for international transactions.
Thank you, Vicky. That was very comprehensive. So my takeaway from that was Model 3, which is about shared platforms, shared ledgers, central banks coming together using common infrastructure presents the greatest opportunity for interoperability. However, as you've said, it's easier said than done, right? Like, I mean, probably it is too utopian to expect all of the central banks to come together on a single platform. So maybe there'll be regional platforms. I do think that, the question raised earlier in some of the earlier discussion, like how do you contain contagion risk in shared platforms? How do you establish common governance, framework? When we talk about governance and legal frameworks like settlement finality, having uniform definition of settlement finality, having uniform AML CFT rules, having basically digital identity solutions, so you don't have to do the same checks at multiple times. I mean, there's so many things that can be done, but Corridor Networks lays the foundations for that. So thanks a lot, Vicky, for giving that comprehensive overview. We will move on to a more practitioner view, from Keith. Keith runs the treasury desk for DBS, one of the best treasury desks in the region. So, Keith, how do you see the role of CBDCs from FX market standpoint as a practitioner, as somebody managing the FX desk? What role do you think CBDCs would play? And what efficiencies could be brought about in the context of FX markets as you see today?
Thank you, Naveen. Thank you for that question. And I also want to thank Mr. Sinha, Mr. Dave, Mr. Ashwini, and the FEDAI for inviting us to this conference. It's a tremendous honor to be here. And look, Naveen, your question is a very valid, is a very pertinent question. Parts of that question have already been covered by Mr. Anuj from a central bank perspective. Another part of it, the triangular structure, has been covered by Wiki from an international or a multi-central bank perspective. But let me just sort of spin it around, triangulate it, and talk about it from a bank's point of view, right? So I think Mr. Anuj made this reference that there's no intention to disintermediate the banks from the banking system, even with the introduction of CBDCs. And CBDCs, yes, 86% of the banks, and since then, quite a few have moved on with trials, etc., gone beyond white papers. CBDCs is an idea whose time has come and it's here to stay. Some central banks are pivoting towards the retail element of it, and some are pivoting towards the wholesale element of it. But in general, I see that the use cases around retail are far clearer. Not to say that the wholesale cases don't exist. I think Wiki spent the better part of the last 15 minutes talking about the wholesale element of this. But CBDCs, from an FX point of view, look, we've seen FX PVP, particularly from a settlement point of view, with the incident that happened with Herstatt Bank and then the risk associated with it. And since then, infrastructure has evolved. We've seen CLS come about, and CLS has been around for the better part of 20 years. But outside of CLS, and CLS itself has limited itself to about 18 currencies, and some of the emerging market currencies, which are growing significantly and growing far more rapidly than most of the DM currencies, don't have not just an adequate representation, but don't have a representation on CLS. The trillion-dollar economies of South and Southeast Asia, including China, India, Indonesia, not represented on CLS. So some of these things need to be addressed. Now, the way we go about addressing it is one is through private networks, and one is through CBDCs. And again, we'll come to that in just a moment, because I think this whole public-private partnership is going to exist, even as far as CBDCs are concerned, because from my point of view and from your point of view, Naveen, we need the commercial banks to help intermediate CBDCs, to help distribute CBDCs, and to some extent help to accommodate the flow. The changing factor today is not M0 or M1. You rightly pointed out, I think the ratio between M0 and M1 globally is either 1:9 or 1:10 or somewhere in that range. Globally, I don't think it's anywhere above 10%, which means that the bulk of the flow is in M1 money, which is largely commercial bank money. But specifically addressing your question around CBDCs, look, CBDCs are going to play an important role. And when it comes to particularly transactions where an FX PVP is required, again, we talked about the risk of intraday risk, settlement risk, Herstatt risk, counterparty exposure. All these are very important. The component of intraday trading is increasingly rising. The component of geographical time zones between Asia, Australasia on this side, and the US on this side is causing us additional issues. That's where I think CBDCs, and particularly the technology that backs CBDCs, whether you call it distributed ledger, whether you call it blockchain, is going to come in to solve some of these problems. Look, the problems have been variously identified by Mr. Anuj and by Mr. Wiki, and the CBDCs will come in to address this. It'll be the technology that helps to solve these issues, where you trade FX for one currency for another and eliminate the risk that we talked about. I'm going to just throw in some random numbers, right? I think if you look at the BIS numbers, I think as of April 2019, the daily FX volumes were about 6.6 trillion. That's daily FX volume. a fraction of those, and that's not a small fraction, but a fraction of those volumes, in fact, it's a significant number, do not settle PVP. If you look at the emerging market currencies, in that very same survey, emerging market currencies have grown to 25% of the total currency pairs being traded on a daily basis. Most of the emerging market currencies don't have an adequate platform. Now, I would want to point out one or two countries, including Hong Kong through HK Chats and India through CCIL, that offer some sort of a domestic infrastructure for PVP. But outside of that, the only other available infrastructure is, to me, today is sort of limited. And that, to me, is sort of a very, very big issue which CBDCs will resolve. We can spend a bit of time talking through Model 1, 2, and 3. Yes, if we congregate a collective attention around Model 3, that would seem like the ideal way forward. But again, every central bank, every corridor, or every cluster of central banks will make their own decisions. The decisions will be made in the best interest of their domestic constituents and made from a point of view of both legal and regulatory frameworks that currently exist. But the one or two points that I would like to sum up is DLT, or shared ledger, shared platforms, lower fees and lower transaction costs, and the third point could potentially be the bedrock from which future innovation could take place, or regional trading blocks could also assemble or reassemble themselves. So these are in sort of closing out my answer, these are the 2 or 3 points I would bring to the fore, which central bank digital currencies could resolve.
Thanks, Keith, as always, very well articulated. Just to probably sort of give my take on it, as you've touched upon that, right? Like, CLS has done such a great job in taking out settlement risk, but the CLS model means that, CLS bank needs to be part of an RTGS in every different country. It needs to be a licensed bank. That model has inherent limitations. A smart contract-based model where you have corridor networks or shared ledgers where two CBDCs could settle atomically, smart contract to smart contract, without an intermediary in between, presents compelling options. In fact, to add to what Keith was saying, the risk-adjusted PNL means that there's a drag of almost 53 basis points to banks on account of fact that you have settlement risk, for a number of currencies. So FX PVP continues to remain, sort of one of the great big opportunities, especially Keith, given the size of the notionals that you've just spoken about. I do have some very interesting questions come through. Now, I will probably do the first question to Anuj. Anuj, this is from Kamath Manjunatha. Don't you think this entire topic brings the capital account convertibility to the fore? I mean, what we've sort of opened up with, and the internationalization aspects, or do you see these as distinct? I don't know if you wanted to take that question, Anuj.
During my already covered that this is one risk which we need to kind of, because of the convenience and the ease, there could be a drag on there could be a capital outflow. So whether the country like India, we need to be very, very kind of aware, and then how do we go about it? So there is always a concern. And when, as I said, the opportunities are there, so but challenges are there, and we need to see how this is also not kind of comes into a problem area for the country and the financial stability and the monetary implications.
Got it, Anuj. And the technology does offer interesting choices, isn't it? I mean, I'm just coming from a pure technology standpoint. The technology does allow for the central bank to be the validator, to be part of the consensus. So which means that you could dynamically implement very targeted rules. I think as part of the opening comments, we spoke about selective convertibility, selective internationalization. taking a nuanced approach was the term that was used. The technology provides absolutely that. So thanks, Anuj. Thanks for that response. And maybe one more question, and maybe Vicky, I will turn this to you before I go back to Keith for his take on commercial bank digital currencies. This is from Kashinath, who says that, and this is a topic close to your heart, it says due to a geopolitical dynamics, a single platform may not be feasible. And I think Kashinath is referring to the fact that you talked about a single CBDC platform shared by multiple central banks. And the question is, geopolitical dynamics, does it allow for that? Even though it's the best option, is it a feasible option?
Thanks, Naveen. So I would say that if you are looking at it from an international level, it's going to be very difficult. Some of the superpowers around the world, how to get them on a common platform, I think that may be very difficult to accomplish. But if you look at on a regional level, there would be regions with very similar regulatory policies, and in fact, they are very close economic transactions with each other, economically perhaps very well integrated among the region. For such cases, I think that there is a possibility that they would see value in a regional settlement platform. Now, even if you look at today's context, the South African region, they actually already run a regional RTGS. So it proves that this is possible. Now, from a technical perspective, the question is really, if you were to build such a shared platform, is it possible to segregate out the layers of control such that each central bank retains full control, full domain over their issuance of CBDCs? And I think this is probably a point where we can take quite a bit of reference from what is happening in the public blockchain world. And it shows that from a technical perspective, this is possible. If you look at, say, for example, public Ethereum today, it is essentially a shared platform that is not within the control of any single party. You already have multiple different stable coins that are issued on it. Each stable coin is issued, maintained by a separate party altogether. But at the same time, you could actually build, say, DeFi protocols that enable exchanges between these different stable coins. So that is really an example of how technology has solved some of these governance concerns, some of these technical controls concerns, and prove that this is really viable from a technical perspective. Now, of course, that is really the public blockchain world. Whether it works within the central banking world, I think that is something that we are exploring as part of the project. But it's always good that we do have reference points to show that this could work. One being what is happening within the public blockchain world, the other being what has already been done as regional RTGS by areas like South Africa.
Thanks, Vicky.
Naveen, I'd like to sort of supplement the earlier point, right, around capital account convertibility. Look, a lot of emerging market economies do face this dichotomy or this split between digital rails on any type of an infrastructure, distributed ledger, or blockchain, etc., versus the legal and the regulatory framework. Now, I think that therein lies the answer. These are two verticals, and there's no intention either by the private sector or the public sector to do away with the current legal and regulatory framework that exists. What is changing is purely the technology, which is making things a little bit easier and a little bit faster and a little bit more efficient. There's no intention to. Now, if it does have the effect, unintended however it may be, of putting pressure on let's say domestic currencies because of a huge capital account flow, like you correctly pointed out, the technology element of it, which is retained by the central bank as part of the central bank's core and part of the the centrality of the data, etc. Some of these flows can be better managed and can be better controlled through this. But the point underpinning all of this is there's no intention to undermine the regulatory framework or the legal framework in any form or manner. It's just meant to make today's rails a little more efficient.
Absolutely, Keith. I couldn't agree more. And, that was the point I was making earlier in terms of the technology providing choices. As what Vicky was saying, is it possible for, different central banks to share a single platform? Well, it's a single platform, but it's not a single platform. I mean, the platform is such that it gives you so many choices. So on that particular topic, to just move the discussion along, Keith, I mean, we've been collaborating between DBS Bank and Jpmorgan along with Temasek for the longest of time. It seems ages now.
Yeah.
In terms of standing up Partier, we've just gone live, which is a commercial bank digital currency network. You spoke about private-public partnership. So where do you see Partier and commercial bank fitting in, even though you address that to a certain extent, M0 and M1, in the world of CBDCs?
Yeah, look, brilliant question again, Naveen. And harking back to what I said earlier, this entire approach, whether we talk about CBDCs in isolation or whether we talk about CBDCs and some of the private sector initiatives, including Partier, to me is going to coexist. Now, over a period of time, there'll be a little bit of movement where one gains a few percentage points over the other, and likewise in some of the other circumstances. But effectively, from a digital infrastructure point of view, this is going to coexist, and not only coexist, one is going to complement the other. Partier, when we spend a lot of time, we spend a better part of the last 18, 20, 22 months actually thinking through Partier and thinking through concepts or rather problems such as FXPVP and CBDCs. And the common conclusion we had in almost every circumstance, including CBDCs, that this would coexist. Partier would even be able to accommodate CBDCs from a model point of view in a public-private partnership. But as Mr. Anuj pointed out, as Vicky pointed out, from a distribution point of view, if you go back to some of the commentary around CBDCs, you'll realize that the interface to the public, whether it's the retail or whether it's the wholesale consumer, is going to be fronted by the banks. The issues around KYC, the issues around sanction screening, etc., the issues around control of the wallets is still going to be handled by the banks. The currency on that a distributed ledger on that ledger is going to be CBDC. So when I think about it in a broader context, the simple answer is there's room for two. For the model answer is yes, the model accommodates and in fact wants, if not facilitates, a public-private partnership. So these and Partier is not the only one, right? Partier is probably the first one of its kind to go live on distributed ledger in terms of payments, particularly as of now, I think Sing dollar, US dollar, additional currencies to come. We'll be able to accommodate CBDCs, and depending on how these things move, and the CBDCs, whether they focus on the retail sector or the wholesale sector or both, the Partier will be those private chains which accommodate this flow. Right? If you're going back to the earlier question which you posed to me around FXPVP, Partier, and again, Naveen, you brought this up, the point around smart contracts and technology enabling those smart contracts, where if you have CBDCs and I forget the gentleman's name who talked about whether central banks would be willing to join a single platform. It could be the private sector that solves the problem, where you could have, let's say, two major currencies, where the geopolitical dynamics are not ideal, not at the moment, but potentially huge trade volumes going through between the two. If they don't want to be on the same platform from a CBDC point of view, you could potentially intermediate that trade through a private network where they'd potentially be more willing to participate. So if you think of instances, or you think of use cases or circumstances, one is private networks will coexist. Private networks such as Partier will facilitate CBDC transactions, and could also potentially form a tangential spoke or a partial solution, if not an entire solution, to some of the CBDC type network problems that could potentially not be resolved, not for problems of technology or trade, but for problems of sort of geopolitical dynamics.
Yeah. No, clearly, Keith. We definitely see these networks as complementary. And you spoke about the distribution model, right? Commercial banks acting as distributors for CBDCs. one of the easiest mental models for me to think through is like, you do that today, right? Like if you think about ATMs, right? What do ATMs do? You know, commercial banks are dispensing central bank money, right? Cash through, you're
Correct.
dispensing physical cash. The mental model is instead of dispensing physical cash, you're dispensing electronic cash, right? Into
Correct.
wallets. Like, you know, so yeah, I do think that, you know, this is like a topic which we can go on ad infinitum, given all four of us are very passionate about this. But I do have a number of questions come through and we are running out of time. So I will select a few things. Anuj, this one is directed at you, and I'm thinking right up your alley because you spoke about this in the beginning. This is from Kashinath, who's asking, do you think account-based CBDCs will be more preferable compared to anonymous token-based CBDCs, especially from an AML and CFT risk standpoint? This is a huge debate. So I don't know, Anuj, you know, if you have a succinct answer.
See, as the very beginning, I said the degree of anonymity. See, why people are comfortable using a physical currency is because there is a degree of anonymity as per law that up to certain amount, you don't have to provide your PAN number or whatever, the KYC. Or even we have accounts which are limited KYC and full KYC. So, account based, definitely it is. If it is through an account, definitely the question doesn't arise. Everything is transparent. But if we want to replicate physical cash with CBDC, unless and until we provide some kind of some degree of anonymity, the acceptance will not be there, and that is where we are examining how do we. And let me also clarify that other legislative amendments are also required because the present act, which allows us to issue currency notes in note form, bank notes, once we move to digital, certain legislative amendments have to be done. So all this has to be under kind of brought under a legislative framework on the degree of anonymity. But I think if we want to really kind of ensure that people use CBDC, token-based would be the right way and with certain degree of anonymity that we are grappling with, and we will come out with something.
Got it. Got it, Anuj. Very clear. Thanks for that. And maybe, Vicky, I'll turn this question from Yogesh Potnis to you. We did touch upon this, but this is very relevant and keeps coming up often. With each country having separate regulatory guidance for cross-border transactions and AML KYC, do you think that a common minimum framework would be a must for corridor networks, or can you still live with disparate frameworks to start with?
Thanks, Naveen. So actually, I will just borrow some of the things which Keith mentioned about, you know, whatever we are building on the system, there's no intention of changing all the legal regulatory framework, etc. So what we are doing today is really as a start, exploring how we can actually build a common settlement platform while still respecting the legal regulatory framework of individual jurisdictions. So from a definition, delineation perspective, we would have to very clearly separate the different activities that are happening on the platform itself. So in that perspective, you know, certain checks that are mandated by local jurisdictions, jurisdictional policies, etc., they would still be done within the jurisdiction itself. So the question is really from an operational perspective, how do we draw the line? And I do think that from a technical perspective, at least what we have seen so far within the project itself, it is possible to delineate clearly the different processes that are happening as part of a cross-border transaction. So for example, anything that deals with AML, CFT, that still has to happen within that single jurisdiction, within the respective jurisdiction, under respective rules and regulations of that particular jurisdiction itself. The only thing that is really international or cross-border in nature is the actual settlement or the movement of funds. So I do believe that from that technical perspective, we are able to map it such that individual jurisdictional needs are still fulfilled on the platform itself. So that's broadly the way which we are thinking of it.
Thanks, Vicky. Yeah, helpful. Certain degree of harmonization is always great, but the whole point is about the technology which can, yeah, Anuj, why don't you go on? You wanted to add?
Just to add to the response to my previous question on token or account based, I would just like to say, because even though there are leaps in digitization and digital transactions in India, the small value transactions, which is for regular expenses, continue to be in cash. So unless it is not token based, those segment of population which is dealing with regular expenses in cash will not move on to zero. Just I wanted to add this point. Thank you.
Got it, Anuj. And there was also a question which had come up in terms of, well, with token based and anonymity, do you see prevalence of ransom and corruption and things like that? Yeah, I mean, with every feature comes a drawback, right? I mean, do you want a surveillance state, or do you want anonymity and privacy, right? Like, that's the debate. So again, as I said, all four of us are quite passionate in our own ways about this topic, and we could go on, but we only have an hour. I thoroughly enjoyed moderating the sessions. I learned a lot. Hopefully it was useful for the audience as well. So on behalf of the other panelists, I would express a vote of thanks to all of the people who pulled in a number of questions. Unfortunately, we didn't have the time to take all of them. So thanks a lot for all of the questions. And I'll turn it back to the moderator, Mr. Devishankar.
Thank you so much to Naveen and his brilliant team. I wish we could give you more time, but then we run a very watertight compartment in terms of time and content, and we have to pack in so many things to make it look so value-added and contentful today. So I'm sure you will understand, gentlemen. Thank you very much for this wonderful panel discussion. I'm sure our attendees have very key, strong takeaways and insights with the content that you shared with them today. Please accept our sincere gratitude for spending some quality time with us today, all the four of you, and for enriching our minds with such good content. So, ladies and gentlemen, that was the wonderful power panel discussion that we had, and thank you for your questions. That shows your quest for knowledge, that shows your yearning for more and more on your plate. Thank you very much. Now we turn on to a very important aspect of today's event, and that is the vote of thanks. With all our wonderful sessions now almost over, I move on to this customary vote of thanks. And to do the honors, I call upon Mr. Shantanu Pradhan. Welcome, Pradhan, sir, Deputy Chief Executive FEDAI, to propose a vote of thanks. Over to you, sir.
Thank you, Mr. Devshankar. So good afternoon, friends. We come to an end of the exciting day today. We started with Mr. Ravi Shankar, Deputy Governor RBI. Mr. Ravi Shankar, of course, I know he's not here at the moment, but I would like to thank him because not only for the wonderful talk on capital account convertibility, but also for the fact that he's been a mentor and guidance for the Forex market, but also more for FEDAI right from the days of his CGM days. We've always enjoyed being with him, and he's been very accessible to FEDAI. So thank you, sir, for your continuous association with FEDAI throughout. Then we had Mr. Ashwini Bhatia, MD of State Bank of India. Now Ashwini Bhatia, again, a very able and competent top executive of State Bank of India, but also a very wonderful person, and has had several assignments in Treasury. So he's also been somebody who's close to the areas that FEDAI works in. So thank you very much, Mr. Bhatia. It's been a wonderful having you and having you speak to on this annual 5th and FEDAI annual day. Then we had that interesting panel discussion on CBDCs, hot topic, but also a fairly new topic for many of us, but made very clear to us by the panelists. So thank you very much, Mr. Anuj Ranjan, GM RBI, Mr. Vicky To from BIS Singapore, Keith D'Souza from DBS Singapore, and Naveen I take last because I just can't say just thank you. A big thank you to Naveen for having conceptualized, anchored, and then participated in the panel discussion. I would also like to thank Mr. Devi Shankar, who has been a wonderful compere. It's been great to have you, and you've brought in a lot of liveliness to the whole proceedings of the 5th FEDAI Annual Day. I would also like to thank our event partners, technology partners, SOTC. We kind of did this at the sort of in a hurry. We got approvals only at the last few days, but then SOTC stood up to the task, and I'm sure they had to do a very hurried and had to do a lot of jobs at the end of the day. But yes, they did a wonderful job at the end of the day. I also would like to thank my colleagues in FEDAI who have made all this, the whole FEDAI Annual Day possible. This is the 5th FEDAI Annual Day. We've been having it every year. Last 2 ones have been digital. The earlier ones were physical and were obviously far more fun. I hope we can do the next FEDAI Annual Day in a physical format, so we can actually meet people and, if not shake hands, because situation may not have permit yet for us to get down to shaking hands, but at least meet people and talk to them. Then also, of course, I would like to thank all the dignitaries who have, attended this event, and all of you participants for having made this event a great success. We depend upon you to, give us the motivation and the inspiration to do more things by your being there and by your participating in the activities that FEDAI does. Having done that, now there are certain people whom I would like to thank who are on a day-to-day basis associated with FEDAI. So I'll take this opportunity of the annual day to thank those people also. First and foremost, the board of directors headed by the chairman, Mr. Rajay Sinha. Then, of course, Prasanna Balchandar from ICICI and Madhur Agarwal from Jpmorgan. Thank you very much for your guidance on a day-to-day basis, and also the freedom that you have been giving us in FEDAI to do various activities and to shape up things. I'd also like to thank various RBI officials from various departments like FMRD, FMOD, DOR, on whose guidance we depend on a day-to-day basis for being able to guide our member banks and to ensure that the forex markets work smoothly and efficiently. There are certain sister organizations that I also would like to place our thanks on their record for the collaboration that we've been having with them. So FIMDA, then Financial Benchmarks India Limited, FIBIL, and also CCIL, Clearing Corporation of India Limited, with whom we collaborate again on a regular basis to ensure that the forex markets work smoothly, and in general to ensure that whenever there are issues which require collaboration and discussions amongst ourselves for the markets work itself, we always have been getting a lot of cooperation from all these 3 institutions. I would also like to place on record our thanks to, a big thank you again to our past chairman, Mr. Raghavendra Rao from State Bank of India, and Mr. Jenna again from State Bank of India, and now CCIL. Thank you, sirs, again for your guidance and the freedom that you have been giving us in FEDAI to think of new things and to do those things, and the faith that you have put in us that we at FEDAI would be able to do a good job. So I won't have to, again, hold all of you from your lunch. So thank you very much for making this event a great success, and hopefully we will meet in the next annual day physically. Thank you very much. Over to you.
Thank you, sir. Thank you very much for your wonderful note here. As you rightly said, that the food for thought for the past 2.5 hours should make way for the thought of food. So, but yes, we have had such a wonderful audience today. Dear audience, one round of applause to you. You've been such a wonderful audience. Thank you indeed. And our sincere gratitude also to all the members of FEDAI. Your wonderful professional contributions for transforming FEDAI today into a robust, dependable, and value-added association today. So thank you very much. Ladies and gentlemen, I enjoyed hosting you in as much measure as you enjoyed being part of this significant meeting place today. We do hope that today's program was able to live up to a majority of your expectations. We at FEDAI attempted to provide you a niche platform for knowledge sharing and intense deliberations. But of course, all of us have the paucity of time. So we were also part of that thing. At FEDAI, our endeavor will always be to curate some of the finest and most comprehensive and futuristic ideas and topics for intense deliberations. And we also keep making conscious efforts at FEDAI to ensure that participants are able to meet up and listen to great achievers and the movers and shakers within the industry, understand best practices, and get various stakeholders, policymakers, users, and market makers closer and on the path of collaboration, growth, and higher productivity. Should you need any assistance moving forward, or do you want to fill in your valuable feedback to us, please write in to us at mail@fedai.org.in. And before I sign off, I will end with a quote by Kim Chase, and who said, "Life is not a competition. Life is about helping and inspiring others so we can each reach our potential." My greetings of the festive season to you and your loved ones, ladies and gentlemen. Thank you and Jai Hind. Thank you, everyone.